We've spent 9 episodes building the pieces: income generation, tax strategy, Social Security timing, portfolio design, and Roth conversions. In this episode, they come all together. This is what a retirement income plan actually looks like. Welcome back. I'm Patrick Thompson, and this is episode 10, the episode where everything we've covered becomes a coordinated strategy. A retirement income plan that isn't a spreadsheet or a single document. It's a living framework that connects your income sources, your tax situation, your investment portfolio, and your timeline, and gets updated as any of these change. Let me walk you through what this looks like for a real scenario. A couple, both 62, planning to retire at 65, 1.8 million across retirement accounts and taxable investments. They want 100,000 per year to support their lifestyle. Step 1, identify and time the income sources. Social Security provides 48,000 per year if both spouses delay to full retirement age. That leaves 52,000 the portfolio needs to generate. So step 2, structure the portfolio for that need. Dividend income and bond interest can cover a meaningful portion of that 52,000 without requiring asset sales. Then step 3, sequence withdrawals intentionally. Taxable account distributions and qualified dividends come first. They're taxed at a lower capital gains rate. IRA withdrawals are layered in to fill the bracket without spiking into the next one. And Roth dollars are held in reserve for flexibility. Step 4, use the pre-retirement low tax window. In year 63 and 64, after income from work ends but before Social Security begins. Roth conversions can be executed at a lower tax rate, reducing future RMD exposure. Step 5, build the portfolio to match near-term income needs with stable assets and longer-term income needs with growth-oriented ones. None of these steps are complicated in isolation. The value comes from doing all of them in a coordinated way because they interact. So how do you know when you're actually ready to retire? Not when the calendar says so, not when you hit a particular account balance. There's a more rigorous way to answer that question, and it's the subject of episode 11.